Welcome to Sales Tax and More, your go-to resource for all things state tax related. Now, here is your host, Michael Fleming.
Hi, everyone. Mike Fleming here, founder of Sales Tax and More, and today's co-host of the Sales Tax and More podcast, where we talk about everybody's favorite topic, which is, of course, sales tax. Today, my co-host, Ellie Moffat, and I are going to be discussing why income tax is the next big battle for e-commerce sellers. But before we get started, I'd like to introduce you to Ellie.
Hey everyone, really great to be here. Sales tax, as we know, is one of my favorite topics. And before we jump in, I want to give a quick introduction for Sales Tax and More. Sales Tax and More is a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consulting, research, and like our name states, more. So if you have questions about our services or you'd like to work with us, please reach out to us. We would love to hear from you. So, Mike, we have been talking about income tax being the next big battle for online sellers for a while now. And in light of Pennsylvania's actions, could you explain this to everyone again?
Yeah, absolutely, Ellie. We first started talking about this, 18 months or so. But it's really starting to pick up steam. And a lot of this is centered around Public Law 86-272. Public Law 86-272 it's a federal law. It was passed by Congress. It was a direct result out of the Northwestern Cement case, which was a U.S. Supreme Court case that pretty much said that you could tax interstate commerce any way that you wanted. And, Congress got upset. The, big business got upset. They said Nexus is so confusing. The whole country is going to go into another depression, if we don't do something about this. So Congress acted very swiftly. And within 7 months, they passed the Interstate Income Act of 1959, which is also known as Public Law 86-272. And by the way, this nullified the Northwestern Cement court opinion, but that was 62 years ago. And Congress at that time said, this is so complex. Nexus is so complex. We've got to form committees. We got to do studies. And once we got our arms around this, then we'll go out and make a permanent rule. Well, that was 62 years ago. And we still have this antiquated temporary solution. And, the economy has changed so much in the last 62 years. I mean, some of you out there, have thought that Congress has do nothing the last 4 years or 8 years or 10 years or 12 years or 20 years. But when it comes to some things, it's always been a do nothing Congress. I mean, 62 years we've had this temporary solution. And the U.S. Supreme Court reminded Congress in 1992 that, hey, this is your job. You need to go out there and handle this Nexus thing. And they did not. So finally, the Supreme Court stepped in, and that's how we got Wayfair. So what Public Law 86-272 actually says is that, state cannot impose a net income tax on you if your only activity in the state is the sale of tangible personal property. The orders are sent outside the state for acceptance, and then the orders are fulfilled from a point outside of the state. So, back then, not too many companies were offering services. So this, protected some companies, but it was, really all about this Northwestern Cement case. That's the fact pattern in that Northwestern Cement case. But as the economy is beginning to change, less and less companies are protected by Public Law 86-272.
So we have all these issues, Mike. It's been 62 years. Why now?
Well, a couple of reasons. And, some of it has to uh, tie back to be careful of what we wish for. Most of these issues are due to Wayfair, either directly or indirectly. So let's look at indirectly first. So everyone wanted the marketplaces to be responsible for collecting taxes. Well, that is a result of economic nexus, which is a result of Wayfair. So, states have a constant need for new revenue. The sales taxes are less of a battle right now. So income tax, these laws have been around forever, but, the states have had a hard enough time, getting some sales tax money. Now they're getting all this sales tax money and they're looking for new sources of revenue. Let's start enforcing some of the older rules that are already on the books, and that is for the income taxes. So that's one big reason. Second reason is, and this is really be careful of what you ask for. The marketplaces are collecting sales tax for you now. But most of the states have written into their agreements that the marketplaces have to provide them with any information that they believe is, pertinent to making sure that taxes are being done correctly. So all of this information about where you have inventory, all of this information about your level of sales is right at the state's fingertips. And we're seeing states like Pennsylvania take advantage of this, and California also. So that's the indirect reasons. The direct reasons, while most states did not require a physical presence, two states that did, prior to this were Pennsylvania and Texas, but most states don't require a physical presence. In other words, intangibles could create nexus for you. But only about 10 states or so had a bright line physical presence. In other words, you cross this number and you have nexus for income tax. Once Wayfair passed, that changed. And now these states all of a sudden are adding economic nexus thresholds for income tax. For example, Texas doesn't have the income tax. I've got the franchise tax, but we're going to, allude to that as a income tax for today's purposes. They now have an economic nexus for their Texas franchise tax. It's $500,000. So you no longer need a physical presence in Texas. Pennsylvania is the same way. $500,000 for the income tax in the state of Pennsylvania. Those were the last two states that required a physical presence, no more since Wayfair. And we're also starting to see a bunch of cities jump on board here. So not only do we have to worry about states, but we got to worry about cities. A real big one is Philadelphia. If you have more than $100,000 of sales into Philadelphia, you now have an economic nexus. And so long as you're not protected by Public Law 86-272, they want you to pay that. And Philadelphia is one of the more aggressive cities out there. They actually use collection companies to collect their taxes. So historically, they've been very aggressive, even when we're talking about a physical presence. And now you just need an economic nexus. I think that they're going to become a lot more aggressive on a going forward basis. The other thing has to do with Public Law 86-272 also. Remember, we said that only protects you from a net income tax. Well, we're seeing states, take an end run around this. State like Oregon, they have an income tax. They don't have a sales tax. And they can't get their hands on any, remote revenue because most remote sellers are protected by Public Law 86-272. So their income tax doesn't apply and they have no sales tax. So what they did is they came out with a gross receipts tax. It's called it's another CAT, just like Ohio. I believe it's commercial activities tax. But it's got a fairly high threshold. When you hit 750,000 of sales into Oregon, you need to register, and you don't need to actually file a return until you hit $1 million is the way I believe that one works. But moral of the story, gross receipts taxes. They're not income taxes, so they're not protected by Public Law 86-272. Massachusetts believes that Public Law 86-272 is unconstitutional in light of Wayfair. So they're going to be looking for a case that they can send to the Supreme Court to try to get this overturned. And finally, perhaps this is the biggest issue. The Multi-State Tax Commission, the MTC, they provide guidance that many states follow in whole or in part as to what protected activities are. In other words, if you're doing just these activities, then they are going to be protected activities. If you're doing these activities, they're not protected, and therefore that's going to create nexus. Most of those in the past, the last time the MTC changed their guidance was 2001, maybe 2002, but it was a long time ago. And, these unprotected activities were all based on a company doing something physically in the state. Well, now in light of Wayfair, they're changing their guidance, and the executive committee of the MTC has already accepted this, and now they're putting it out to the states, circulating it amongst the states, to see if they're going to adopt it. As of now, it's not been adopted by any states, but it basically eviscerates, the protections of Public Law 86-272. If you're using cookies on your website, most websites nowadays do, they consider that a type of physical presence. So therefore, you don't have the protections of Public Law 86-272. Post-sale emails or chat features. If you're providing any type of customer service on a post-sale basis, and a lot of companies do that, that is no longer protected by Public Law 86-272. In other words, it exceeds the sale of tangible personal property, or the act of soliciting tangible personal property. It's very narrow protection there. And then even inviting people to apply for a job. If you have any type of language asking people to apply for a job, even if they don't apply for a job, that's enough to invalidate the protections of Public Law 86-272 based on this new guidance. Now, we may see some lawsuits about this. We may see Congress get back involved. I don't think they will, but, hey, they may. It's been 62 years. Maybe they'll weigh in again. But there's an all-out assault on Public Law 86-272 at this point. So that's why we're starting to see this become a bigger and bigger issue now, for multiple reasons.
Thank you for going into some detail on those, Mike. So I want to talk about FBA sellers. I've heard you say that FBA sellers are low-hanging fruit for the states. Can you expand on that a little?
Yeah, absolutely. So let's go back to Public Law 86-272. We said that, one of the things that, the orders have to be fulfilled from a point outside the state. And if you're an FBA seller, fulfillment by Amazon, you probably have inventory inside the state. So at least in a lot of states out there, not all states, but a lot of states. So at least some of your sales are being fulfilled from a point inside the state, which right away that, breaks the protections. And it's all or nothing protection. I mean, you don't, just look at this and say, okay, I'll pay income tax on 20% of my sales because they were fulfilled from a point inside the state. And I don't have to pay tax on this 80% because they were fulfilled from a point outside the state. It doesn't work that way. It's all or nothing. Once you're not protected by Public Law 86-272, you are not protected for any of your sales into that state. So the states are truly looking at this low-hanging fruit. So we've seen California. They were the first ones to start this. They got a list of people or FBA sellers who had inventory in the state of California. and they started going after them. And they're being a lot more aggressive than the California Department of Tax and Fee Administration ever was. California Department of the CDTFA, they let this stretch on forever. The Franchise Tax Board out in California is not. They are going after people pretty rapidly. So if you're an FBA seller, you have inventory in California, you were their first on their list. It's easy to find out that you have inventory in California. Remember we said the states have all this information at their fingertips now? So they have a longstanding position that inventory creates nexus not only for sales tax, but also for income tax. So they were the ones to start this off. They fired the first shot in this new battle for, e-commerce sellers. Pennsylvania, started it 2 months ago. We just, been talking about this a lot recently. They sent out a letter to mostly FBA sellers reminding them that, hey, inventory still creates nexus, and not just for sales tax, but for income tax also. So they have a special voluntary compliance program. It is up on, the voluntary compliance program, they just extended till June 8th of 2021. And, I think it's something that people should really take advantage of, not just for the sales tax. Amazon's been collecting the sales tax. So if you're only collecting on Amazon, you don't have to worry about the sales tax portion of this. If you're selling on Shopify or your own website, now you got to worry about the sales tax, because Pennsylvania is saying, hey, you may be under my $100,000 threshold, but you have inventory here. And a physical presence always overrides an economic nexus. So you need to be collecting tax on these other platforms. And oh, by the way, you need to be paying the income tax also. Even if you're only selling on Amazon, you still got to pay the income tax.
So, Mike, let's talk a little more about Pennsylvania. I've heard you talking to foreign sellers about them having an income tax responsibility in Pennsylvania. What about the tax treaty?
That's a great question. And, states are sovereign. So they're not parties to the tax treaty between the U.S. federal government and a foreign government. So the tax treaty deals with, the federal income taxes. They do not deal with state income taxes. Now, states can choose to follow the tax treaty, and the majority of states do, but there are 13 states that actually do not follow the tax treaties. So Pennsylvania is one of those states that does not follow tax treaties.
Okay, and while we're at it here, we've talked about the Pennsylvania Special Voluntary Compliance Program for PA in 2 previous podcasts. I think we've mentioned it at some other places. We've had it all out on our email, social media. Do you want to share the latest updates?
Yeah, absolutely. So as we were saying, it is extended to June 8th. And what the program is it limits the look back period. So instead of going back, a normal VDA, if you wanted to do that, goes back 3 years and change for the sales tax, 4 years and change for the income tax. This special program is only for people who have inventory in the state of Pennsylvania, and it goes back to 2 years and change. It goes back to January 1st of 2019. So it's got a very limited look back period, which is nice. It's going to waive all of the penalty, which is also nice. So to me, it's really a great program. And, all of these people are getting letters and they think that, hey, we don't have to pay attention to this. Pennsylvania is not the CDTFA out in California. They are not going to let you, ignore this for months. But they have told us they are coming hard after everybody. So right now they're in their good guy mood. They, extended the date that you can, the cutoff date where you can submit things. But once they close this out, they're going to start coming after people hard for both sales tax and income tax, based on people who have inventory in the state. They're going to come after a whole bunch of things, but they're going to be concentrating on this inventory. And, a lot of foreign sellers say, well, Mike, good luck of them trying to get us. We're a foreign seller. Well, they have these reciprocity agreements with a lot of the states have gotten together. And the states that have ports in them, they're making it so that they can, uh, you know, impound some of the shipments as they come into the ports. So that's one way. Pennsylvania has a load of Amazon warehouses and other types of warehouses. They figure out you've got inventory there, and they already know if you're an Amazon seller, they already know you have inventory there. They're going to be going after that. And the accounts receivable. If you're selling in a marketplace, you have money sitting here in the United States, and states will go after your accounts receivable. I've seen them do it before. And Pennsylvania says, hey, we're going to do this. And by the way, we're just the first state to do this. You're going to see a lot more states doing this. So even foreign sellers should be paying attention to this.
So does all of this apply to FBA sellers only?
Uh, no. FBA sellers, it's low hanging fruit because they have inventory in a lot of states. So if you have inventory in a state, Public Law 86-272 does not apply. So that's why the FBA sellers are the low hanging fruits, and the states can very easily get that information. Other states, right now, states like Texas, Ohio, Washington, the Kentucky Limited Liability Entity Tax, these are all gross receipts taxes, and or they're non-income taxes. So you've got to worry about these today, even if you're not an FBA seller. Anyone who's getting registered in a state for sales tax should be worried about these gross receipts taxes. Now, in Texas, if you only have an economic nexus, then you got to worry about if you're over the 500,000 for economic nexus for sales tax, then you're over the economic nexus for the franchise tax. Same thing in Ohio. In Washington, it's $100,000, and that's the business and occupation tax. And that's actually filed as part of a sales tax return. So even if you don't have a responsibility for sales tax, you may have a responsibility for the business and occupation tax. For larger sellers, we've got to worry about states like Oregon or Nevada, and that's today. That's not in the future. Oregon, 750,000, and Nevada is 4 million. And all of these are not protected by Public Law 86-272 because they're not net income taxes. Now, these are not the only states that you have to worry about, but by far, these are the most common states. These are where most of the issues come up. Anywhere you have inventory, you're going to be subject to an income tax. Over the next 18 to 24 months, as there's a continued assault on the protections of Public Law 86-272, we're going to find that we need to, pay income tax in more and more states. So it's not just going to be FBA sellers. For non-FBA sellers, there's a little bit more than a handful of states you got to worry about today. But this is going to become a much, much bigger issue over the next 18 to 24 months.
Mike, you talk a lot about materiality for sales tax. Do we need to look at materiality for income tax as well?
Yeah, absolutely, Ellie. Number one, unlike sales tax, I think Tennessee is the only state with a minimum there, but most other states don't have a minimum for sales tax, but there is a minimum for income tax in a lot of states. So you got to look at that, number one. Number two, your exposure for income tax generally going to be a lot lower than your exposure for sales tax. Sales tax is based upon gross sales. Income tax usually based upon your net sales. Usually it's a big difference. Let's look real quickly. $100,000 of sales. If we have an 8% sales tax rate, you're going to owe roughly $8,000. Let's say that you've got a 10% profit margin. On that same $100,000 worth of sales, you'll have roughly $10,000 apportioned to a state. And then you're going to pay 8% on that, and that's $800. So, you have to have a lot higher sales numbers in a state before the numbers start becoming material. And just like sales tax, if the cost of compliance is going to be higher than, the actual amount of tax owed, a lot of times it makes more sense to just let the state come and find you. Now, as it starts getting material, no, that's not an option. If you have exposure and it's material, you got to take care of it. But accountants charge all different types of fees to file state returns. I've seen, $350 all the way up to $1,500. If your accountant's charging you $1,500, you might want to find a new accountant. But if you don't, if you like them and stick with them, then, the amount of money you owe, should exceed $1,500. So yes, we still have to look at materiality. And most of the states are looking for the medium to large sellers anyway. They don't want to, chase sellers who, by the time, everything's apportioned out, the net income tax is $100. That's a whole lot of work for not a lot of gain. So the small sellers are not at risk as much as the medium-sized to larger sellers, and larger sellers really need to be paying attention to this.
Mike, thank you so much. We've had so much great information here today. Is there anything else you want to cover?
No, just that we appreciate you joining us today. We hope to see you or be with you on the next episode of the Sales Tax and More podcast. And if you have any great ideas for an upcoming session of the podcast, please let us know.
Let us know. And if you'd like to work with us again or have questions about our solutions and services, please reach out to me directly at eMoffett. That's EMO, F as in Frank, F as in Frank, A as in Apple, T as in Tom, eMoffett at salestaxandmore.com, or just hop on over to our website, salestaxandmore.com. Thank you so much, everyone.
Take care, everyone.
Thanks for listening. Be sure to click subscribe and check out all of the resources we have out on the web.